Okay, so welcome everyone to another exciting guest speaker. Today we have Ed Rios, who used to be my student many years ago,
Yeah, that's right.
15 or 17 years ago,
Right.
in 2008. And he moved back to the US. He's American from Texas, and he's now a professor himself. He's also an investor, an angel investor, and he's a banker by profession. He's going to tell you everything himself. So he's going to speak about the subject. This goes to his heart, like entrepreneurship in the US. Then you can ask questions. Over to you, Ed.
All right,
Thank you.
thanks. So we'll try to figure out the math on how I can actually be Jacob's student since we're probably like 4 years apart. But that's a whole nother story. Maybe he'll bring me back next year. Anyway, how's everybody doing this morning? Fantastic. So I'm a little groggy because got in yesterday and there's like a 6-hour difference. So for me, it's about 5 in the morning. I've been up for about 3. So if it takes me a while to enunciate and get things out, that's what it is. It's not the brain surgery I had 2 years ago. And we can talk about that too. Whoa, that's not gonna work.
Switch it on? Yeah, thank you.
So let me just get a feel for the class because I understand this isn't the class. This is more of a group of students, some from different classes that Jacob's taught over the semesters. What majors do we have? I know each year your finance business had the Finance Student Association. Is that correct? What about you guys?
Business tech and entrepreneurship.
Oh, okay, interesting. Yes, sir.
Innovation. Business and innovation.
Innovation.
I'm on exchange. I'm not, yeah.
Yeah, I went to course.
Exchange. He's an exchange.
Exchange.
Oh, that's cool. No worries. Yes, ma'am. California.
Business and innovation.
Where in California?
San Francisco. But
Oh, man, I love San Francisco. Hard to live there. But yes, ma'am.
International business.
International business. Yes, ma'am.
Innovation business.
Innovation and business. Okay. Yes, sir.
Finance.
Finance.
Business marketing.
We know this. Yes, ma'am.
finance.
Finance.
Business and innovation.
Business global management.
Global management.
Exchange.
Exchange. So what would you like? When you say exchange? What would you normally be studying?
France. He's
France.
France, Australia.
Oh, wow. Okay.
So we have a very international crowd here.
Yeah.
So like,
Yeah. Clearly.
From Austria to Australia.
Yeah.
Get the joke, right?
Well, hey, thanks for joining me this morning. I really appreciate it. It's always nice to get a semi-full room. So we can go in a lot of different areas today. I really just like to get a sense of where everybody's sort of skill set is on what I can talk about, right? I think Jacob said I was a banker. Well, I'm not a banker anymore. I was a banker for like 25 something years, but I don't do that anymore. I'm a reformed banker, right? So I don't feel like I need to do that anymore, and I don't want to. But if you're interested in being a banker, commercial, investment or otherwise, I think it's a great career. Who, if anybody in the class, currently has either a side hustle or an existing business? Aspirationally, is anybody thinking about launching a business or a side hustle? Does everybody know what a side hustle is?
Mm-hmm.
Okay. Has anybody had a side hustle, thinking about launching or thinking about launching a business?
Not that soon.
Not that soon. Okay.
Eventually.
All right.
informally,
Four more years?
in like, sort of, I wouldn't say it was like an official side business.
Okay. What is that? What are you thinking about doing?
Well, it's already open out. I used to sort of set up a program where I'd send out a mailing list to real estate agencies around my city and just sort of like allow tenants to compare utilities bills, and if they use the website and actually switched over their utilities, I'd get a bit of a commission fee from it. So
Right.
calling up people, getting mailing lists to all different real estate agencies. And then, yeah, so I did that for about a year and a half. So
Okay. I like the model. I like the
Yeah.
model. How did you get your leads?
well, my parents were real estate agents, and then I had a few mates as well, so I spoke to their parents as well, and then just
Yeah.
driving around just to different real estate agencies and just going in and just asking to meet the principal, telling them what I did, and then just going from there.
Okay.
They'd say, yeah, sure, go for it, and then we'll take a bit off the top as well, or they'd say, no, I'm not interested.
Yeah.
So yeah, it worked pretty well. It was pretty successful for a bit, but it definitely got a lot of people who were...
Now, is it still active or is it dormant?
No, it's gone now. Once I came over here, I couldn't
Yeah,
really
yeah.
run it from the other side
Yeah,
of
it's
the
a little
world.
different.
So yeah, maybe when
Okay.
I go back
Okay.
if I have time, I'll start.
Okay, so we're going to come back to you. You've launched and you had some some success with that, right?
Yeah.
Okay. Young lady from San Francisco. I don't want to call you young lady from San Francisco. What is your name?
Sia.
Sia. Sia. So you had an experience.
No, I said eventually I'd like to have my own business.
What is that? What are you thinking?
Well, I haven't narrowed it down to exactly what, but I'm interested in like the consulting field. So ideally it would be like having my own firm and something, a boutique firm, of course.
Areas of interest.
Marketing and strategy.
Okay. All right. Okay. Those are your strong points.
Yeah.
Okay. So I think the thing, first of all, to talk about, I'd like to get a quick sort of gauge for the risk tolerance of the class. You guys talk. I think if you were just in Jacob's class or you've had him before, you guys talk about risk a lot. Let's try to put a quick. 10 would be great, but we'll do 5. Real quick, 5 investments. And they can be anything. Like, are you guys really big into sneakers? When I was okay, you guys know sneakers. So it could be a pair of whatever the sneaker is. They're collectibles, so you can put the name out there. So let's rate a couple of things as either highly risky, medium risk, and low risk. All right, but don't get caught up in the HML right now. Just give me the first investment. What is it what you'd put? Let's say we've got £500,000 to put into a portfolio. First $100,000, where are we going to put it? As a group. Don't take too long.
Stocks.
A little broad. It's a little broad, but that's okay. What do you mean specifically when you say stocks?
So just like stocks of companies like Apple or.
So are you talking about a diversified fund, or are you talking about individuals?
I am talking about individuals.
Okay, so name one and let's pick one.
Apple.
Okay. All right. I like that. All right. What about number 2?
Passive fund or gold, something like that.
Ooh, metals. Very interesting. Passive. 3.
Just invest in an app, maybe?
In what?
In technology?
In technology. So when you say technology, that's a little broad. So try and narrow it down for me.
The chip business.
The chip business. So we're going to say the semiconductor. Is that?
Yes.
Semiconductor. So who's a big semiconductor player? You want to do a startup, or do you want to do someone who like a Siemens? Siemens is chips.
Yes,
Siemens
Siemens
is-
quite big. but-
All right, we'll say Siemens. So that's another. That's the FTSE. That's everywhere. So that's a stock, right? Okay, next one.
Bonds,
Bonds. Any particular kind of bonds?
treasury,
Treasuries. U.S. Treasuries.
probably most likely, yeah.
Ooh, the old risk-free rate.
Or German.
Don't worry, I know what I'm writing up there. You don't have to know what you're writing. Last one.
Startup.
Ooh, finally we get to
Finally.
little risk. Okay. All right, so let's rate these out. Apple, high, medium, or low? In terms of risk, really? Okay,
Medium.
good. All right.
Metals.
I said I could
You can't-
read it.
you can't
I
read
said
it.
I could read it.
Metals,
but, metals,
passive.
passive. High, medium, or low?
Low.
You agree? Low?
No.
I'm not excited. I don't do
High.
metals. Is it?
If you say low, I would say high.
We're gonna put it metal. We're gonna put it medium. Well, let's leave it open. Siemens. Good cash flows, good dividends,
Medium to high.
medium to high.
Mm.
So we'll go ML maybe?
Yeah, if they're based in Taiwan.
We'll do ML here too. This is kind of jumpy, so that's why I would kind of say high as well. I'm gonna leave that. I'm gonna go high. All right, U.S. Treasuries. Well, absolutely. I mean, if there was anything less than low, we would probably do that, right? So let's go low. Startup.
Hi.
Okay. If there was anything higher than high, we would definitely go higher than high. Okay, so just in broad strokes, right? If we look at this, a couple of medium to lows, which are interpretable any different ways. One low here, and one high. Any kind of patterns?
Yeah, low risk.
Yeah, in terms of which low, medium, low, highs. Any patterns you see? Remember, this is actually probably closer to a high.
Sorry.
Yeah.
We have balanced portfolio.
Bam. There you go. Right. How did we do that? The crowd decided, right? So the herd mentality just kind of decided it, right? So I do this as an exercise to show you that in general, the notion of a crowd, right, will typically gravitate. You'll get the extremes, right, in either case, but at the end of the day, you'll gravitate to some level of a balanced portfolio, right? So if we concentrate on any one of these, we'd be overexposed, right? But we're asking for, 20% allocation in each one? So we're reasonably balanced, right? Because if we have, what is Treasuries going to do for us?
Steady cash flows.
Steady cash flows,
Cool.
right?
Yeah.
Right? If I'm a fund manager, right, a micro fund manager, and somebody entrusts me with $5 million or pounds to put into different positions, and if I put this position together, right, what kind of, I mean, we don't know what the returns would be, but would you feel reasonably comfortable in just broad strokes pitching this on a seven slide deck?
Guess depends what their aims are. If they're looking to make serious profit, then no. If they're looking to be short and stable,
So what does that say about people putting money in your deals?
who put money in, well, you have to understand their risk tolerance.
That's one. And what else?
And also the if you're the manager, your own risk adversity.
Well, that's you, but it's also driven slightly by because, money is money, right? If it's coming your way, you sort of have to bow to that. So but there's something else that your clients are telling you, that your investors are telling you.
Well, they want to maximize profit.
Well, if you have a baseline of what you're looking to do, and let's say that you're putting everything in, let's say you're doing everything in Bitcoin. I don't do Bitcoin. And no offense to anybody that loves Bitcoin. I've been in finance 30 years. I still don't understand it. So nobody needs to try to explain it to me. It's just not going to work. The point is, I wouldn't be interested in your fund. So what does that say about your audience again? What message are they getting? If people are talking to you,
you're not taking enough risk.
No, if people are talking to you because of your allocation, what does that mean?
Because of the allocation, they're attracted to
They're attracted to your investments,
Yeah.
right? So you're in industries, right? You're in industries or segments that they're interested in,
Yeah.
right? So investors, from an investor perspective, they're always going to be looking for investments that they're interested in. If I don't like Bitcoin and you pitch me on Bitcoin, right, and you got an amazing proposal,
Yeah.
am I likely to say, I'm sorry, what's your name?
Caleb.
Caleb, I say, hey Caleb, man, I love you guys. You're it. I'm doing your deal. No, it's not going to happen because I don't understand it, right?
Yeah.
So I'm going to gravitate to the areas that I know, because how much time do I have to invest to go learn about Bitcoin?
Yeah.
Too much time, right? So I'd rather do a fund of funds where I've got some ample distribution and that's a small allocation. Everybody know what a fund of funds is?
It's like an ETF.
Anybody? So a fund of, yes sir?
Is it like a portfolio where you choose portfolio managers and you diversify between different portfolio managers?
So in the venture space, very close, exactly. It's basically a fund that's making investments in other funds. So if it's a VC fund, right, you're investing in Regents 3, right? And Regents 3 is then making 5 investments in 4 distinct micro venture funds or venture funds or anything for that matter. So that's a fund of fund. It's bifurcated process there. So okay, let's get back to the startup. All right. So level of risk here. High. All right. Any ideas on what we want to make, build, start?
Cash flows first.
Well, no, I'm talking about like type of business. Let's pick an industry real quick.
Tech? Tech?
Ooh. All right. Tech. All right. So, who's going to put money in our deal? Let's say, Caleb, you're ready to go. You've got your deck, right? You're ready to present. Who are you going to present to? You've been in the incubator program here. Is it still an incubator? Okay, still an incubator. So there's an incubator on campus. You've got your idea going. You're ready to present. Jacob says, hey, I've got these 5 individuals. They're scattered across the U.S. I set up a Zoom call for you. They're ready to listen to your pitch, right? they're all angel investors, and they may be willing to do your deal, right? So, is that going to be typically your first pitch?
No.
Who are you going to go to first?
Friends and family.
Absolutely. The one you missed one F. Friends, family, and
Fools.
fools. That's right. Because anybody that's willing to put money in a startup when you have proven nothing is insane.
Yeah.
But I've done it several times and continue to do it. So you think I would have learned by now. Anybody familiar with the cone of uncertainty?
Sort of.
So the cone of uncertainty, something along these lines, right? This is the beginning in the this is the beginning of the life cycle of a startup, right? This is everything we don't know, right? This is maybe Series A. Does everybody know what Series A is? No? Okay, so different series of funding, right, on a startup. The initial, so if we don't take any money from anybody and we raise our own money, we use our own money, right, that's called bootstrap, right? If we go do a friends and family round, it's called a pre-seed or a friends and family round. Then you can do a pre-seed round, then you can do a seed round, then you can do a Series A round, right? And then you can do a B, a C, and then now there's even like L rounds. If you're doing an L round, you're not going anywhere basically, right? I mean, you need to go do something else. But in the beginning, right here, there's a lot we don't know. And I don't know you. You pitched me a deck. Maybe I got an introduction to you from Jacob, and he says you're a good kid, you're really smart, you know what you're doing. So I listened to you, right? And you tell me you've got some sort of tech play. Whatever it is, I don't know. But it sounds interesting. And let's say for argument's sake, in this particular space, that I'm interested in it, right? And I say, okay, well, let's give it a go. All right, so angel investors typically are going to make investments. So here, let me back up for 1 second. In general, what do you think the startup point here is in terms of capital I'm trying to raise? Unproven, nothing.
Yeah. Couple grand, maybe?
No, that'd probably be friends and family.
Okay. For angel investors.
What's that?
100,000?
A little bit more. So I would say 150 to probably 250 would be the max, right? All right. So still gonna have some friends and family, right? But really your audience there is angels. Maybe some accelerate. I don't know if they have those programs here or not, where you can compete with your plan, and the first prize is $50,000 or that kind of stuff. I know Rice University back in Houston has a big one. I'm sure some universities do here as well. Those particularly in innovation. But so 150 to 250, right? All right. Typical angel's going to write a check, and we'll just say if I go between pounds and dollars, I mean the same thing, right? So I think that the trade today is $1.26, so it doesn't really matter.
29.
129.
129, yeah.
You're always on it, man.
We're on the way up.
On the way up. Okay, that's supposed to be 50, by the way. So average check size from an angel is anywhere from 25 to 50K. All right, that's so if I'm looking to raise anywhere from 150 to 250, if I'm getting checks at 500, I'm going to have probably 5 angels in my deal. Or maybe let's say 4 and then a bunch of friends and family. There's one thing missing in that pot of money that as an angel, I'm going to want to see. What is that?
In the pot of money itself.
Yeah.
Return. Like what do you guys?
No, more basic than that. You go to a bank and you buy a car. What does the bank ask you for?
Oh, capital.
How much?
Fair bit for that.
About 10% down? So what do I want to see?
Down, like deposit.
Some of your money. I want your money in the deal, right? A little bit of skin in the game. It doesn't have to be a whole lot of money. Because, right, as a student, and I don't know everybody's net worth here. I mean, I don't need to know that. Point is, let's say that you've got $10,000. That's a lot of money in the, hey, depending on where you are, that's all the money in the world. You tell me that you put that into your startup, guess what? You're all in. I know you're all in because you put every bit of money you've got in it, right? That means a lot to me. So that's the only other piece that's missing, right? Let's say you got a little tranche of friends and family. So you'll have some of that in there. And then you've got some angels that come in. Okay, so what's an angel? In the UK, I don't think the definition is too different, but it's typically breaks down to being former executives, professionals that have some level of liquidity, right? Fancy themselves knowledgeable in certain industries and like to invest in startups, because the real simple notion of startup investing is the following. If you make anywhere from 10 to 20 startup investments in a well-diversified portfolio, right, most are going to go bad. So in a 10 portfolio, probably 8 of them will go bad, but one will do really well. And the overall return on that one, right, will make up and compensate for the losses to get you to an average return of about 23 to 27%. You know, some maybe some higher in some markets, maybe a little bit lower in others, but in general, right? So it's a really interesting asset class, right? So who participates in angel investing? Well, the SEC and probably, is it not FINRA here, it's the FSA. FCA probably has the same requirement. You have to be what's normally referred to as a qualified investor. So a qualified investor is a function of either your annual income or your net worth. I think in the States it's $250,000 a year. Yeah, and it's $1 million in net worth, right? I've made numerous angel investments, and I've never had anybody qualify. Or not anybody qualify. I've never had anybody ask for financial statements to prove it, right? Because what happens is the company provides you with a form that says that you attest to that fact, right? That you are a qualified investor. So I've never seen that tested anywhere. I don't think we ever will. You know, if you think about it, with so much money that goes into startup financing, who's going to legislate that? Right? So I mean, nobody does, right? So anyway, that's what a qualified investor. It's someone that supposedly knows better, right? Because if you have a net worth of at least $1 million, or you make at least $250,000 a year, you should know. Doesn't really mean that, right? I mean, it's just a form. We got to have some sort of guidelines, right? So that's typically the way that breaks out. Okay, so angel investors from that standpoint then take on a whole different form, right? Some of them will be specific to industry. So some will say, okay, I want to do oil and gas deals. I want to do healthcare, right? I want to do fintech. I want to do whatever industry, consumer packaged goods, right? And in all of those, you have to develop some level of expertise. So usually, if you worked for Coca-Cola or for PepsiCo for 25 years, and you retired, you were, let's say, a mid-level executive, and you have a nice portfolio, retirement portfolio, let's call it, and you want to get a little bit of a little alpha, add a little alpha to your portfolio, you might delve into angel investing, right? What's the likely type of companies you're going to invest in if you worked at Coca-Cola or PepsiCo?
Other beverage companies, retail, yeah.
Consumer packaged goods, right? Why? Because you know it, right? So anything else that you do is a function of what you can learn about. Because with your fund, your Bitcoin fund, if you come to me, I've got to go learn everything about Bitcoin. Because so far to this point in time, I refuse to accept it, right? I mean, and that's true.
Yeah.
It's not that I don't believe in digital currency. It's just I got a whole other issue about that. So we get back to where we are on that. I'd have to go to school, right? And that's kind of more than I want to do. So just like scaling a business, right? How do I get better in an industry that I don't? How do I immediately get better in an industry that I don't know very much about?
Research.
That's one.
Talking to people.
What did you say?
Talking to people.
Talking to people. Do you guys remember that show, Who Wants to Be a Millionaire? You know, the phone a friend? So I called Jacob because he has a background experience, let's say, in fintech. And I said, Jacob, I got this deal. What do you think? Bam, all of a sudden I've got a collaborator, right? So sometimes what you see, and I usually do the same thing, with a group of 2 or 3 other angels, right? Who have specific expertise, I may delve into something because there is the expertise that I'm looking for. I don't have it, right? But they do, so I'm relying on their ability. But I've probably done a deal with them before, and I feel real comfortable, right? Okay, so Now I'm in the deal, right? I'm an angel investor. I'm at the very beginning of the transaction. News company raised $250,000. I was, let's say I wrote a check for 50, right? So I'm in for 25% of the deal. I probably signed a safe note. I'm not going to go into the ins and outs of a safe note, but basically that's it's a promise for future equity, right? A lot of ways to structure deals, whether it's subordinated debt, right, or actual equity. But at the very, very, very beginning, we're going to try to delay any kind of valuation. The entrepreneur is anyway. And even from our standpoint, because it's kind of hard to get a fix on something we don't know what's going to happen. So you're probably going to sign a safe note, which is a promise for future equity. You know, it doesn't really mean anything. But the truth is, once we can get to a verifiable valuation round, then it's going to mean something, right? So in follow-on rounds, as more money is coming into the deal, and we move down this cone of uncertainty, more capital needs to get added, right? Because what are we doing in a startup? We're launching a company and we want it to
Get customers.
but like just
Make money.
blow up. We want to explode, right? So does that happen overnight?
Can do.
Can, but a lot of times it takes a lot of cash, particularly in the specific types of industries. So in particular, consumer packaged goods. You got a new drink, right? You got a new energy drink, right? Is that an easy sell?
No.
Probably not, right? There's all kinds of stuff out there, right? I mean, I know the US brands, not so much the UK brands, but the point is that takes a while. You know, by the time you're in Whole Foods and Waitrose and in every off-license corner shop, it could take a while. It's going to take a lot of cash burn. So it's like millions and millions of dollars to get to that product to where you need it to be. So that means we're going to have a whole lot of follow-on rounds, right? So equity is finite, right? If you own 100% of your business, there's only 100% of it, right? You obviously are going to retain a certain amount because you're a founder, right? But you're going to have to parcel off bits of it to raise that capital, right? By the way, in the event that you're selling your company, remember, you can always maintain control through the term sheet. It's not a function of owning 51%. It doesn't have anything to do with anything. Control of the company is you can legislate that through the term sheet. So for founders that sort of get stressed out because they're selling 30% at the beginning, it's not that big a deal, really. I mean, are you trying to grow or not, right? So think about it in those terms. All right, so as we get further on down, we've got more money coming into the deal. So with each addition of investors, something happens to my original investment. Anybody familiar with that word?
Dilution.
I get diluted out a little bit, right? Because the percentages are changing. So I probably get invited for a follow-on round. Follow-on rounds where I can invest. Sometimes if I negotiate it right, maybe at a discount, so I'll get a preferred rate, right? So if I come in that next round, maybe instead of, so my dollar is worth $1.10 for the new equity. Does that make sense? Right. So I keep going. But in the beginning here, it's all a dream, right? Because nobody knows anything. There's been no proof of concept. There's been no first million in sales, right? None of that kind of stuff. As the cone of uncertainty, as we get down here, something really interesting has happened. You guys have been talking about it a whole lot, and we didn't get into it on our portfolio. But the transaction in and of itself de-risks. You guys familiar with that term? Mm-hmm. So if you de-risk something, what are you doing?
Taking up the systematic risk.
And some of the market risk too, right? Or the administrative, well, so there's a whole chapter probably on risk in the book that you guys are doing, right? So as many of those risks as you can control, right? It makes the investment reasonably safer, right? So coming in on this end, right, is a whole lot easier. Angels don't come in here, right? Because the dollar amounts are usually a lot higher. Someone that's here in a Series A round probably has already sold 1 million units or whatever the milestones are, right? And what I would say is you're seeing more and more of milestone financing, whether that's first million in sales or first million in products sold or distributed regionally, right? Now you're in all the western states, right? Something like that. All right, so based on those requirements, you'll see more money coming into the deal. You get here, here's where a venture fund is interested. The venture fund is interested because there's some scalability there now. The company knows, the venture fund knows, the venture capital says, you know what, this thing can be the next vitamin water, right? So we're in. We're in for $3 million. But hang on a second, we're gonna do 2 tranches. Actually, we're gonna do 3 tranches. $1 million at the first, you reach this milestone, then $1 million, and then after whatever it is, another $1 million, right? Because they wanna see milestones. So if you look at where venture is since COVID, we've seen a lot of contraction in, well, in really everybody's portfolios. And the primary reason is everybody's recalibrating. So it used to be, I work with a few founders that have invested in their companies that tell me all the time that 2.5 years ago, 3 years ago, you had an idea and people would give you $1 million. And that effectively was true. I mean, there were some deals out there where, people would throw money at you. That is no longer the case, right? Markets have moved, people are looking for efficiency. So if I made a commitment to you as a venture fund, and I said, I'm gonna do $1 million, right, on this date, a lot of that kind of got recalibrated, and most fund managers said, you know what, we're gonna do $500,000. What can you do with that? We'd like to see your efficiency ratios get up to here before we do more, right? And that's because you have to understand the way the venture world works, not on the angel side, but in the venture world. So if I'm a fund manager at a venture, like you were the fund manager in our scenario, right? Is it your money that you're investing on behalf of your investors?
Yeah.
No, is that your money?
For the business that I had.
No. Where I said you were the venture. I'm
yeah.
sorry. So remember I said you were going to be a venture. You were the venture investor.
That's right. No, their money. Yeah.
So okay, all right. So you got to raise money externally, right?
Yeah.
So you want to have fund 1, fund 2, fund 3, fund 4, right? Typically a 7 to 10 year life, because that's a career, right?
Yeah.
You've built out a career in venture. If fund 1 isn't where you thought it was going to be from 3 years ago to today, how likely are the investors from fund 1 going to be willing to put money into fund 2?
Not too much.
Not very. So there's been a complete recalibration, right? Everybody's talking about efficiencies and trying to get to where you've got some sort of real numbers in your business, right? You can't just live off what's projected. So projections are still important. Total addressable market is still important, right? But more so than that, people want to see some level of operation, some level of efficiency. So I think that fleshes out. What happens is this will all sort of in the next few years, well, we did have an election in the US, so we'll see how that goes. But the point being, this should flush out. What I like to say is that people that were in venture, people that were in angel investing that probably shouldn't have been, those people are out, right? They're completely out. Because when treasuries went to 5.5%, guess what? You could get 5.5% on your money for doing what? Nothing, right? And here I am sitting, waiting 10 years for maybe this startup to blow up in an industry that I barely know anything about. So I either really have to enjoy doing that, right? Or why would I be in it, right? So anybody that wants to get some stable level of return. So if treasuries are up to 5.5%, I don't know what the S&P was doing. You could probably tell me better than I can. And so everybody's been migrating to sort of those safer havens, and what we sometimes call the dumb money is out, right? The so-called smart money is still in there, but what we find more and more smart money is never that smart. So there's been a recalibration, right? So if you're in venture now, if you're an angel right now, it's because you really want to be in there. You're willing to do the research, and it's not fun. I mean, it's work, right? It's like a job because you're interviewing potential investments, new people. I probably meet, and I do a very curated approach. I'm not a member of an angel network. And angel networks are just groups of 10 to 100 angels that'll invest. So they'll usually write in groups of 5 to 10 much larger checks. So they can fund up to 2 million, a million, or something like that. But what I find in those organizations is that they have a pretty specific outlook in terms of industry that they're looking for. And in Houston in particular, that's probably going to mean oil and gas. And my wife works for an oil and gas company, so I avoid any oil and gas investments just because of any potential conflict of interest, right? I don't want any company that I invest in possibly having a contract, doing business with. So I don't do that. It just makes more sense. So I don't do oil and gas. So my view is kind of more curated. I work with founders that I've worked with before, and my deal flow, right, comes from those same founders. So, companies I've been interested in. I like some consumer packaging good companies. I like some fintech plays. They've got to be sort of interesting, and I got to be able to understand them. I like.
You gotta be able to understand the idea, or how to say how it works.
I've got to understand. I think both really. Yeah, it helps. It helps if I understand both. Well, I think really what's more important for me, who's your customer? What are we selling them? So I'll tell you one fintech company I'm involved in, without naming them. They do payroll services, right? It's all automated. It's all it's all cloud web based, right? Very specific. It's addresses. The entire website is in Spanish. It's in English too, but they're primarily addressing. I don't know what you call it here, but like sole proprietors that are paid. They're called 1099s in the U.S., where you're not on a regular wage.
Okay.
So you have to file your own taxes as a business owner. I don't know what they call that here. But anyway, so particularly targeting that group because it's like a huge number, right? I like that business because I can understand the customer, right? I've done business with and I've financed plenty of the customers that they're looking to help. And the last thing those individuals are usually thinking about is their payroll, and more importantly, their payroll taxes. Because in the U.S., if you don't pay the payroll taxes on behalf of the employee, right, they can accrue to millions of dollars, and the fines for not paying are huge. So it's really important because a lot of people forget to do that, right? So the company addresses a need, right? It's a pretty decent market. They're about to do their Series A, right? Good management team, 3 individuals, all males. That kind of goes against my typical mantra. I like primarily to invest with female, women and minority-owned firms. So these guys are a little bit different, but it's okay. I like them. Upside of it, I think within 2.5 years they got to over 16 million in payrolls. That sounds like a lot, but it really isn't. So the exit there is for someone like a ADP to come in and buy them out, right? Them going public doesn't really do it. It's a strategic acquisition. So keep in mind, when we're talking about startups, a couple of outs, right? The first one is a strategic acquirer comes in and buys you. So the drinks company we talked about, that the Coca-Cola executive put together, maybe Pepsi buys them out, maybe Coke buys them out at a multiple that they're happy with, whether they do earnings multiple or whatever. And we don't have enough time to go into all that. But so that's one option. The other one is IPO. But there's less and less IPOs. You look at the data that is coming out of PitchBook, right? And overall IPOs have been low, particularly last year. The promise is that this year IPO action is going to be a whole lot more interesting. Not really too relevant for the stage where a lot of my companies are right now. The closest one I've got is probably still 5 years away. So, this isn't a sprint, it's a marathon, right? You're kind of sitting here watching it happen, in real time. And it takes a bit. I think the other thing that's real interesting about investor perspectives, specifically as it pertains to angels. A lot of people get into angel investing thinking it's an active business. I was talking to Jacob about this before class. And I have a number of founders that I've invested in where there is some active involvement. What that I mean is, they'll call me and they'll say, hey, I have a question about a banking question on how to negotiate something with a bank. Well, yeah, I know about that. I can help you with that, right? But in general, if you're an angel investor, right? So do you think, you're all the entrepreneurs. If we're right here, and I wrote you a check for 25,000 or 50,000 pounds, and you're right here, how much are you thinking about me? Zero, right? It's very unlikely that I even can get a hold of you, right? And that's the nature of the business, right? Now, like I said, it is in some cases, you find some active angels, and more than anything, that's because you're bringing something to the table, right? So if you have a background in finance, right? You were a banker for 25 years. I think I did that, right? Okay, and they have they don't have a CFO yet. Maybe, so they're gonna have some questions, right? By the time you get to venture money on this end, well, those guys are gonna want you to have a CFO. It can't be some angel. I mean, you'll probably be an advisor. Maybe I end up on a couple of boards, right? A couple of small boards. I'm not talking about like publicly traded boards as an advisor. But when venture comes in, everything else changes because they're going to set up a different board. It's going to be a completely different setup, right? So this is early on during the de-risking. It's really, I liken it to throwing darts at a board, right? At a dartboard with hope that you get a bullseye. To at best a well thought out guess of what might happen. So you really don't know. So what do you think, with the time left, are the things that I'm going to key in on when evaluating an investor, and as an investor, evaluating an entrepreneur that I'm thinking about investing in? What do you think is going to be important to me?
Look at comparable companies, same as I did.
It's early on, it's hard to tell, but that is important.
The
What
question itself.
Yeah, absolutely. It's all about the jockey in the race, right? The horse is important, but the jockey's really important, right? I've got a number one, let's say you bring me a deal, or you bring me a deal. I just don't like you. You're just a rude dude, man. I mean, I just can't, I love your idea, but I just can't get comfortable with you. I can't figure out what it is. I mean, and it happens all the time. There's some pretty annoying people in the world, and you don't even have to be very annoying to bother me, right? So I get annoyed by 90% of the people in the world. So the point is, you know what I mean? So this is about all the social interaction I'm going to be able to have today, right? After this, I've got to go back to my hotel and just decompress, right? Because by nature, I'm an introvert. Anyway. So yeah, the fit's got to be right? There's got to be some shared values, right?
Yeah.
So I've got to know that you have an interest in developing a market that I'm interested in, right? And that probably some thought process about the direction. But again, knowing full early on that there's really nothing I can do to impact that, right? So that's really important. How important is it that you've done a deal before, as an entrepreneur?
Pretty important, I'd say.
It helps.
Like some kind of experience, yeah.
It helps.
Yeah.
They call that going around the track, right? And it's more important that you went around the track, and even if the deal didn't pan out, because you've already been through the process at least once, right? So I like community banks. Those aren't really venture deals, right? But I like to invest in community banks, and I like those because the returns are pretty consistent. And depending on what you're trying to do there, it's always kind of a fun play. But when it comes to a community bank, it's always about, in my opinion, the individual who's going to lead the team, right? And that individual has been around the track before. Even if the bank didn't succeed, and by the way, the default rate of banks in the U.S. is very, very low. In general, in the U.K., it's also going to be very, very low. So it's one of the safest investments out there, by the way. I'm not talking about J.P. Morgan. I'm not talking about, I wouldn't not say Metro Bank here. Those guys aren't doing well. But Barclays or any of those. I'm talking about community banks, and which isn't a big market here. You don't have a lot of community banks, but in the U.S., you got to remember the capital requirements to set up a bank in the United States are really small, particularly in Texas. I think it used to be $9 million. It's not really hard, right? The bank I'm talking about is one that had about 40 million in assets, about 10 million in equity. What we did there was the investment team went in and basically did a tender offer. You familiar with a tender? That's where it's not really a change of control. It's just offering a liquidity event to some existing shareholders so that they can sell what is an illiquid stock, because if it's not publicly traded, right, there's no market for it. So a value is ascertained. I go in and I say I'm willing to put X amount of dollars into this deal, and it's a exchange, right? So then the new management team goes in and you decide the strategy for the bank. So if the bank was agricultural and rural, because it's an agricultural and rural area, right? The business plan is either to expand that or to expand in another way, right? Well, I don't know, I don't want to speak for the bank, even though I know the guys pretty well. My guess is they're going to put an office in Houston. They're going to put that's like saying we're going to move, have an office in Birmingham or whatever, and then grow a book of business that way, right? And to expand the commercial lending side, right? Because at the end of the day, if we don't have producing assets, we can't grow, right? So we can grow organically, right? Or we can grow by acquisition. So, and the same thing kind of occurs here. Sometimes what you see is startups in similar veins will acquire other startups, right? Because they want either their technology or they want their people, right? So, so people are really important, right? And then, but the interesting thing about people is you can't fix them, you know? People, they come the way they come, right? People can learn, I can learn, but you can't fix me. I'm sort of set in my ways. At 57, sort of done. You know what I mean? I'm not going to do very much different than I've been doing for the last 57 years. You know what I mean? So, is it possible that a founder has the ability, they're a really good fundraiser, right? They can make all their marks, and then you get in the actual running of the business, and guess what happens? Or what can happen?
Goes bust.
They don't know how to run a business, right? Or they can't run the ins and outs. They're great fundraisers. They can put a deal together, but operationally they're not. So then the decision usually has to be, normally that comes in later stages, like in venture funds usually will remove the CEO. And that's in the documents anyway. That's never done there are examples where it's done in a kind of a pretty terrible way, but in most cases, everybody knows that can happen. I've got plenty of friends that work for private equity funds or for venture funds, primarily private equity funds, and they were CEO for like 6 months after the PE firm came in, and bam, they're gone. Now, they did really well, they got taken care of, but they just didn't fit the direction, right? And that happens, right? So it happens in the venture space world. At the beginning of the cone of uncertainty, do you think I have any input on deciding whether my CEO gets to stay?
No.
None whatsoever, man. Because we're like a really small little bit of the entire investment picture, right? So the idea is just sticking with it on follow-on rounds for me to make the decision about whether or not I want to continue. Let's say on evaluation, on a percentage basis, I'm in at 0.5%, which is what it could be, and I want to maintain that. Well, that means on a follow-on basis, I've got to probably continue to invest. So if you put in a fund together, like we did here, right, and we had 500,000, we actually wouldn't do 500,000. We'd probably have a fund of closer to 6.5, because why? We're going to have follow-on investments, right? And so we want to have some what they call dry powder for that, to be able to do that. So the notion of kind of hitting it big overnight with a startup and making tens of millions of dollars, oh, absolutely, it can happen, but it just doesn't work that way typically, right? It's anywhere from a 7 to 10 year horizon. Takes a lot of patience, but it's fun, I got to do something, So I really enjoy it, and it always makes great case studies for some of the courses I teach in entrepreneurial finance. I love working with the founders I work with. I always learn a lot from them, and like I said, it keeps me really active. So I'll answer any questions because I think I've already.
We have
kind of gone.
3 minutes left.
Oh man!
Any questions?
Sorry. If you stay past
More
12,
questions?
I know that you really
I
found
can't
it
believe,
interesting.
yeah, unfortunately we need to wrap it up. Any questions? No? Dimitri? No one?
Yeah, I was curious. So, why don't you invest in, if you have a career in banking, why didn't you choose to like invest in just like banking sector, or I don't know, if that's
Well, I do community banks. I like community banks because I understand how banks work. But I mean, money center banks like J.P. Morgan and that. I mean, there's some level of growth there, but in terms of growing an enterprise, that's not really where they are. Right?
So thank you so much, and
Yeah.
it was amazing. Round of applause. Come again and tell us more in the near future. Thank you
All
so
right.
much. Thank you. So.